Hey, this is Jussi. I run a small investment firm that specializes in REIT investing, and recently a client of mine asked me what are the best REITs to buy for the rest of the year. I thought that this is an interesting question because we're now in late October, we're right in the middle of REIT earnings season, and so we're getting a lot of new interesting information on how different property sectors are likely to perform as we go into 2026. Now, I don't have a crystal ball, and so I cannot tell you how any given REIT will perform over the next few months or even next few quarters or year. However, there are three property sectors that clearly stand out to me as potential big winners for 2026. We plan to accumulate a lot more of these specific REITs over the coming weeks, and in today's video we're going to discuss those in more detail. The first category that stands out are apartment REITs, and to be more specific, those that focus on rapidly growing Sunbelt markets. Those REITs have gone through a roller coaster ride over the last 5 years. Initially, they enjoyed a boom in new demand following the pandemic, which resulted in rapidly growing rents and occupancy rates, also compressing cap rates since interest rates were very low. But this then naturally attracted a lot of developer interest who started building a lot of new communities, especially in markets like Texas and Florida. But this has then now led to oversupply, and that's what we've been dealing with over the past few years. As a result of this, rent growth has stagnated or even slightly declined in some markets like Austin, and at the same time interest rates surged, so this was a perfect nightmare for apartment REITs. You had declining or stagnating rents coupled with rapidly rising interest rates, and so not surprisingly these REITs really took it on the chin. Their market sentiment suffered significantly, and as a result many of them are now today trading at decade low valuations, with a lot of them like BSR REIT, Camden Property Trust trading at 25, 30, even 40% discounts to their net asset values in the most extreme cases. But the reason why I think that these REITs are about to turn the corner and start to enjoy significant upside is because their valuations are very low, and I think that fundamentals are set to improve very significantly as we go into 2026. The interesting thing about real estate cycles is that they tend to repeat themselves. When conditions are really good, this attracts developer interest, they start building, eventually they build too much, this leads to oversupply. But then as we hit the point of oversupply, eventually the developers get hurt. And this is what has happened now as interest rates surged, cap rates expanded, property values dropped a bit, especially since rents declined, and as a result now in many cases the construction cost of new communities is higher than the property values. And so a lot of developers have gotten hurt, they've gone bankrupt, they've been forced to scale down new projects, and as a result of this now new construction starts at a decade low. What this means is that the new deliveries of apartment communities should drop very significantly as we go into 2026, and so as a result the supply-demand condition should improve a lot more in the landlord's favor now already in the near term, and apartment REITs have been discussing this on their earnings call. Camden Property Trust, which is one of the biggest apartment REITs in Sunbelt markets, has said that they expect rent growth to accelerate to 4% in 2026 and to closer to 5% in 2027. Recently, one of our analysts had the chance to talk with the new CFO of BSR REIT, which is another apartment REIT focusing on Sunbelt markets, and he seemed to confirm what Camden is saying. He also thought that rent growth is very likely to accelerate now in the near term. We're not talking about 3 years from now, we're talking about in a couple months already as we go into 2026. And so I think that this will surprise the market because right now apartment REITs are priced for no growth. They are priced at a significant discount to the net asset values, despite historically having traded at slight premiums during most times. And so I think that this will surprise the market very positively already in the near term, since these REITs are now priced for no growth. Most people see them as value traps. They're trading at large discount to the net asset values, despite historically having traded at premiums during most times. But now as rent growth accelerates in 2026, even as interest rates are cut down significantly at the same time, conditions will essentially reverse now. We went through a very tough down cycle with rising interest rates and declining rents, but now we will see exactly the opposite as we go into 2026 with rapidly accelerating rent growth even as interest rates decline. Just the other day we had another soft CPI reading which suggests that the next rate cut is just around the corner. Currently the debt markets are predicting about 100 basis points worth of rate rate cuts over the next year. And so I think that the combination of these two factors, higher rent growth with rate cuts, is a very powerful catalyst for apartment REITs, especially since they are so heavily discounted still at the moment. And for this reason, this is the highest sectorial allocation in our entire portfolio, and there are a lot of opportunities in this property sector. One of our favorite is BSR REIT, which we have highlighted quite a few times on this channel. It's a smaller apartment REIT that specializes specifically on the Texas Triangle of Austin, Houston, and Dallas. These markets suffered a lot in the recent years, but we think that they still enjoy very attractive long-term growth prospects. Rents are still very affordable. Rent-to-income ratios are well below national averages, and yet it's one of the most heavily discounted REITs. We like the management a lot. They're very shareholder friendly. They're constantly buying back shares. And yes, as I mentioned earlier, we recently got to talk with their CFO. If you want to read that full interview, you can access it with our 2-week free trial. It will be the first link in the description of this video. The second property sector that we think stands out today as we head towards the final weeks of the year are industrial REITs. And I'm not here referring to just any industrial REIT. To be more specific, I'm referring here to those that own smaller properties in supply-constrained markets. And so good examples of that would be Sigro PLC in the UK, or if we're now looking at the US, that would be East Group Properties for Sunbelt markets, or Rexford Industrial for coastal markets. And the story of these industrial REITs is quite similar to that of apartment REITs in that their market sentiment suffered significantly in recent years due to oversupply and the surge in interest rates. However, once again here, developers have now gotten hurt, they've scaled back projects, and therefore the new supply under construction has now dropped to historic lows. And the reason why we think that these REITs, specifically those that own smaller properties, multi-tenant properties with a lot of small space in supply-constrained markets, will positively surprise the market going 2026 is because now supply is crashing down, and we expect demand for these specific properties to surge already in the near term as a result of the AI revolution. It's going to accelerate the two mega trends that have made industrial REITs so rewarding over the past decades. The first one is e-commerce, and the second is onshoring. AI is accelerating e-commerce because it's going to make shipping a lot cheaper thanks to autonomous vehicles. Secondly, it's going to make online marketing so much more powerful because it's going to be far more personalized than ever before. And so I think that those two things combined together alone will greatly accelerate the growth of e-commerce. It will lead to companies like Amazon gaining an even greater market share of the whole retail landscape. But on top of that, importantly for these smaller multi-tenant industrial properties, I think that this will also lead to a boom in new small business formation in the e-commerce space, since AI is now making it easier than ever before for anyone to start a small e-commerce business. From day one, thanks to AI, you can have perfect looking website, very good copywriting, you can have a very good ad strategy. Things that were before quite difficult today are becoming very easily accessible for everyone. You can have almost free customer support thanks to AI. I have a good friend who has an online business, and he used to hire a bunch of people to handle this. Now AI is doing most of it for free for him, or at a very negligible cost. And so I think that all of this is breaking barriers to entry. It's going to lead to a lot new business formations, and so this then will lead to more competition for industrial space, specifically in these multi-tenant properties that offer small spaces in supply constrained markets. And the second trend of onshoring, I think, will also accelerate as a result of AI and robotics, as it will close down the cost gap to some extent that these emerging markets have enjoyed relative to the US over the past decades. It's only going to make the cost of domestic supply chains a lot more competitive compared to these other markets. And so I think that this will motivate a lot of big international companies to bring back at least portions of their supply chains to the US, again leading to more demand for industrial properties. And so what this means is that right as supply is crashing down, demand is expected to accelerate now already in the near term. And again, we're not talking about 3 years from now, we're talking about 2026. This is just a few months away. And you don't have to take this just from me. You can look at the recent results of Prologis, which is the biggest industrial landlord in the entire world. It has already released its Q3 results and noted a significant improvement in leasing conditions. I think that this is at least partly because of what I just explained, and I think that this trend will now continue as we go into 2026, and it makes industrial REITs very compelling given that they are still trading at decade-low valuations, just like apartment REITs. REITs like East Group Properties have seen their valuation multiples cut in half since their peak of 2022. I agree that the valuation of 2022 were perhaps a bit stretched, but even just to return to halfway to their previous peaks, now their share prices will need to rise by about 50%. And again, as I mentioned earlier, interest rates also expected to be cut at the same time, and so this is a very powerful catalyst, a combination of lower interest rates with faster rent growth, and therefore we're currently accumulating a lot of industrial REITs at High Yield Landlord. Lately, our biggest purchases have gone towards the British industrial REIT SEGRO PLC, ticker symbol SGRO, which is trading on the London Stock Exchange. We got to buy quite a bit of it at around 650 British pence per share. Since then it has already surged quite a bit higher because it posted good results, but even today at about 750 British pence per share, we think it remains very attractive. Hey, before I go into the third property category that we're currently accumulating, can you please do me a huge favor and click the like button if you think that this type of content is useful. As you can see, I'm still currently traveling and I'm still trying to post regular content for you for free, so I would greatly appreciate it. Thank you very much. The third property sector are service-oriented strip centers. And so I'm not talking here about malls such as those of Simon Property Group or outlet centers like those of Tanger Outlet. Those concern me a bit because of tariffs, also because of a potential recession in the near term. However, the service-oriented strip centers are far more resilient, and so I'm not that concerned about them. These focus typically on things like groceries, discount retailing, home improvement, have dollar stores, a lot of services like quick service restaurants, dry cleaners, barber shops, and so on. These are fairly defensive categories. They are not particularly cyclical, and what's important here for this property sector is that it's already today heavily undersupplied. However, the market has not recognized this just yet because 2025 results were impacted by unusually large retail bankruptcies, which has delayed growth. It led to a temporary dip in occupancy rates. It also led to a temporary surge in capex and leasing costs as these vacant space had to be redeveloped and released to new tenants. However, as we now get these new tenants coming in and start paying higher rents as we go into 2026, the growth will start to show on the bottom line, and I think that this is going to greatly improve the market sentiment of these retail REITs, which are today still heavily discounted. Just recently, I had the chance to interview the CEO of Whitestone REIT, ticker symbol WSR, which is one of our favorite REITs in this space. Again, if you want to access our full interview, you can join us for a 2-week free trial. It will be the first link in the description of this video. But in short, what he's saying here is that they expect 3 to 5% same property NOI growth through 2029. And I think that this is very interesting because it's unusual for REITs to issue such long multi-year guidances. So it really shows just how confident they are in their property sector, and I understand why. It's simply because it's so heavily undersupplied today. There's been very little developer interest for a very long time because retail was out of favor due to the narrative that e-commerce was going to kill all retail. And as a result of this, now occupancy rates are historically high, there is limited new supply, but the demand is growing, especially in strong Sunbelt markets like Austin, Phoenix, Dallas, where REITs like Whitestone are operating, and so it's resulting in solid rent growth. Despite that, a lot of these REITs are today trading at just about 10 to 12 times FFO, 20 to 30% discounts to the net asset values, and I think that these discounts are likely to disappear already in the near term as rent growth accelerates, even as interest rates are cut down to lower levels, and therefore we've been accumulating more shares of REITs like these. This includes Whitestone REIT, but also Kimco, Kite Realty, and quite a few others. Now, if you want to access our full portfolio with all our transactions in real time, you can join us at High Yield Landlord for a 2-week free trial. It will be the first link in the description of this video. Now, let me know in the comment section below what REITs you're buying for the rest of the year and going into 2026. I'm curious to know more. Thank you very much for your interest and see you at my next one. Bye-bye.